Financial collapse rarely happens all at once. It usually unfolds quietly over time until one final moment makes everything visible. For the Duke and Duchess of Sussex, that turning point appears to have arrived just days ago. Ignore the speculation about a simple move or lifestyle change. What is reportedly unfolding behind the gates of their Montecito property is not a casual transition. It resembles a rapid financial unwind. While most people were unaware, the California chapter of their post-royal life seems to have reached a critical deadline. This is not about headlines or celebrity rumors. It is about numbers, contracts, and obligations coming due at the same time. According to emerging reports, the couple has vacated their $14 million residence under mounting pressure. The timing suggests it was not a voluntary decision, but one driven by urgent financial constraints. Several converging factors appear to have made remaining in the property untenable. Three pressures stand out. First, the reported loss of homeowners' insurance coverage on the property. This alone can trigger serious consequences when a home is financed through a large mortgage. Second, an alleged financial dispute with a major streaming partner involving the recovery of previously advanced funds. And third, the absence of expected family financial support, which appears to have closed off what may have been viewed as a final safety net. Taken together, this situation looks less like a personal setback and more like the breakdown of a business structure. What we are witnessing is not a lifestyle adjustment, but a financial reckoning. To understand why activity reportedly took place late at night, we need to examine the document that set everything in motion. It arrived mid-morning on a weekday. It was not fan mail or a business proposal. It was a formal notice from the property's insurance provider stating that coverage would not be renewed. The policy protecting the estate was set to expire within days. To many homeowners, this might sound like an inconvenience. Call another provider, secure a new policy, and move on. But high-value properties in California operate under very different rules. The state is currently facing an insurance availability crisis. Major providers have reduced or eliminated new coverage due to rising environmental risks. Areas like Montecito, with dense vegetation, steep terrain, and a history of natural events, have been reassessed as high-risk zones. From an insurance perspective, the property is no longer seen as a luxury residence, but as a significant exposure. Here is where the real problem begins. The home is not owned outright. It is financed, and under standard high-value mortgage agreements, continuous insurance coverage is not optional. It is a contractual requirement. If coverage lapses, even temporarily, the lender has the legal right to demand immediate repayment of the outstanding balance or begin foreclosure proceedings. In this case, the reported mortgage balance is substantial. Without insurance in place, the financial clock starts ticking the moment coverage ends. At that point, only two realistic options exist. One is to secure specialized insurance from high-risk providers, which often requires extremely large upfront payments. The other is to pay off the mortgage in full immediately. Available information suggests neither option was financially accessible in the required time frame. This explains the urgency and the sudden movement. But as attempts were reportedly made to resolve the insurance issue, another assumption appears to have collapsed. The couple's long-term financial planning relied heavily on income from entertainment contracts, particularly a high-profile agreement signed several years ago with a major streaming platform. That deal was expected to provide stability and flexibility. However, instead of relief, reports indicate a demand for repayment of funds tied to unmet production obligations. Rather than providing liquidity, the contract may have become another financial constraint. With insurance unavailable, mortgage terms tightening, and expected funds no longer accessible, the situation appears to have reached a breaking point. This is not a story about personal failure or public image. It is a case study in how overlapping financial risks can compound quickly when assumptions no longer hold. When lenders, insurers, business partners, and personal networks all reach limits at the same time, options narrow rapidly. That is the reality behind what appears from the outside to be a sudden departure. And it raises the final question. When every institutional door closes at once, what path remains? This was not a routine contract update. It was a formal legal notice activating what is commonly known in the entertainment industry as a repayment clause. According to multiple reports, Netflix has requested the return of roughly $20 million that had previously been advanced. The reason cited was straightforward. Agreed-upon projects were not delivered within the terms of the contract. For anyone who has managed a business or signed large agreements, this kind of clause is serious. But many people misunderstand how major entertainment deals actually work. When headlines announced a deal valued at $100 million, the public assumed that amount was paid up front. That is not how these contracts function. In reality, large sums are typically issued as advances tied to future production. The money is released with the expectation that successful projects will follow and justify the investment. In simple terms, it works like this. Funds are provided early to support development, and completed content is expected in return. If that content does not materialize, the advance can be reclaimed. Several years have now passed since the deal was signed. Aside from a single documentary focused on past events, little has reached completion. An animated project was discontinued, and other proposed productions reportedly did not move forward. What was once viewed as a high-profile partnership has since been reassessed through a purely commercial lens. Streaming companies operate as businesses, not patronage systems. In the current climate, profitability and efficiency take priority. When results do not meet expectations, companies act to limit losses. Invoking a repayment clause does more than request money back. It immediately halts access to any remaining funds under the agreement. The original contract value becomes irrelevant once performance obligations are unmet. This creates a serious cash flow problem. Any expectation of future payments disappears overnight. And without incoming funds, other financial obligations become much harder to manage. At the same time, the existence of an active repayment dispute makes it extremely difficult to secure new partnerships. In the entertainment industry, reputational risk spreads quickly. Other studios are unlikely to engage while a major contract dispute remains unresolved. As financial pressure mounted, it became clear that expected income would not arrive. With limited options remaining, attention reportedly turned back to family ties in the United Kingdom. A call was placed to Prince William, not simply as a brother, but as the current steward of a historic estate. Since inheriting responsibility for the Duchy of Cornwall, he has operated less as a family member and more as an executive overseeing a vast, long-term institution. Rather than responding emotionally, he reportedly requested a detailed financial review. Using internal assessment tools, the property and associated costs were evaluated strictly on sustainability. The findings were unfavorable. Annual expenses associated with the estate were substantial. Property taxes, private security, insurance costs prior to cancellation, utilities, and grounds maintenance combined into an annual figure approaching several $million. This was before accounting for mortgage payments. From a financial perspective, the property was judged to be a continuing liability rather than a stable asset. Any financial assistance using duchy resources would have raised serious governance concerns. Those funds are designated for public and institutional purposes, not for personal rescues. Using them otherwise could have triggered public scrutiny and formal investigation. The conclusion was firm and final. No financial support would be provided. The recommendation was simple: sell the property. That refusal was not rooted in personal animosity, but in responsibility. Institutions cannot be used to support unsustainable decisions. With that option closed, attention turned to the last remaining ally in the United States, a longtime supporter who had previously offered extensive help during earlier transitions. For several years, this individual had provided housing, transportation, and security during a period of uncertainty. That support was given freely, without contracts or expectations. However, when a new request was made, the response was different. From a business standpoint, continued involvement carried increasing risk. Financial advisors reportedly raised concerns about exposure, regulatory attention, and ongoing obligations. The Sussexes are no longer operating under the protection of royal institutions, nor do they appear to have the backing of major entertainment partners. As a result, they are now navigating life without the traditional layers of security and stability they once relied on. With their primary residence vacated and protective arrangements scaled back, they have entered a new phase of their post-royal lives. Some insiders have described this period as one of constant movement rather than settlement. For the first time, Prince Harry is living without a permanent base. There is no palace, no official residence, and no long-term home anchoring daily life. What may appear from the outside as travel or flexibility is, in reality, a reliance on temporary arrangements. Available filings connected to their business entities suggest that they do not currently hold other residential properties in the continental United States beyond the Montecito estate. This indicates that their next steps are not a simple relocation to another owned home, but rather a series of short-term solutions. This kind of lifestyle presents unique challenges. For most people, staying in hotels or short-term rentals is an inconvenience at worst. But for individuals who have publicly stated security concerns, constant movement introduces additional complexity. Permanent residences allow for controlled environments, vetted staff, and consistent security protocols. Temporary locations do not. Hotels and rental properties involve shared spaces, rotating personnel, and limited control over surveillance systems. Staff access, building management, and third-party service providers all increase the number of people with proximity and information. In today's digital environment, even small details can travel quickly. Each stay creates a record. Each booking leaves a trail. Meals, transportation, and check-ins all generate data points that did not exist when living behind a secured perimeter. At the same time, protective coverage has reportedly shifted from elite intelligence-driven teams to standard contract security. This represents a significant change in capability. High-level protection focuses on prevention through information and advance awareness. Conventional security, by contrast, is largely reactive. This downgrade limits the ability to anticipate risks before they materialize. That raises an obvious question: why not return to the United Kingdom or simply purchase a more modest property? Both options appear constrained. A return to Britain reportedly lacks the infrastructure that once existed. Without an official residence, there is no automatic entitlement to state-backed protection. Re-establishing security would require private arrangements in an environment that remains publicly charged. Remaining in California presents its own difficulties, including financial pressure and limited access to favorable financing. Ongoing contractual disputes and insurance challenges make securing a new property far more complex than it would be under normal circumstances. Lenders evaluate risk carefully. Reduced income certainty, unresolved obligations, and insurance complications significantly narrow available options. The contrast is striking. A figure who once lived within the framework of one of the world's most established institutions is now navigating a far more uncertain reality. Beyond financial strain, the deeper impact is reputational and personal. This phase is not defined solely by money or logistics. It reflects the loss of permanence, predictability, and status, elements that once formed the foundation of daily life. What becomes clear in moments like this is a hard truth. Freedom without financial stability quickly turns into instability with better packaging. As options narrow and support systems disappear, Prince Harry appears to be left with very few remaining paths forward. Without a permanent home, reduced security, and limited cash flow, only one meaningful asset remains within reach. That asset is not property, influence, or institutional backing. It is his personal story. Within the publishing world, that story still holds value. A potential follow-up book, reportedly discussed internally by those familiar with the matter, may now represent his last major opportunity to generate immediate income. For a public figure whose previous memoir drew global attention, revisiting personal experiences could offer short-term relief, but at a significant personal cost. When an individual has already stepped away from formal roles and exhausted commercial ventures, there are few remaining options. What is left is perspective, memory, and emotion. As this chapter of the Montecito situation closes, one difficult question lingers. What choices remain when stability is gone and relationships are strained? Some observers believe a second book would be an act of necessity, a way to protect his family during a period of financial uncertainty. Others see it as a step too far, reopening wounds for personal gain. From a broader viewpoint, this moment reflects the deeper lesson of the Sussex story. Prince Harry once equated independence with separation from the royal institution. But independence in its truest form requires the ability to stand alone without relying on past structures, borrowed credibility, or future promises. Markets do not offer loyalty. Contracts do not replace community. And freedom cannot be sustained through debt or conflict. What was once framed as a bold new beginning appears to have concluded quietly, with legal notices, financial reassessments, and difficult decisions. Now, the question turns to the public. If a second book is released, is it an act of survival in a time of crisis, or a step that crosses an irreversible line? That conversation is now open.